Have you ever wondered how one of the world's most powerful economies crumbled within a few months? Let's rewind to the early years of the new millennium. The United States was experiencing a housing boom. Homes were being bought and sold at a brisk pace, and prices soared. This was fueled in part by subprime mortgages, loans given to home buyers with lower credit scores who wouldn't ordinarily qualify for conventional mortgages. Meanwhile, global banks were playing a risky game. They were creating complex financial products, packaging these subprime mortgages into securities and selling them to investors worldwide. These products were like ticking time bombs, their value tied to the ever-increasing housing prices. But then, the unthinkable happened. The housing market began to falter, home prices started to fall, and suddenly those subprime mortgages weren't looking so prime anymore. With that, the dominoes were set for a financial crisis. This was the prelude to what would become a global economic meltdown. As the housing market began to falter, the dominoes were set for a financial crisis. Imagine a bubble growing bigger and bigger, and then suddenly, it bursts. That's what happened to the housing market. The housing bubble had been inflating for years, with prices soaring beyond sustainable levels. B-roll banks were doling out loans like candy, packaging them as mortgage-backed securities, and selling these financial products to investors worldwide. It was a high-stakes game of hot potato, and the banks were playing with fire. B-roll, what they didn't count on, was the bubble bursting. When it did, the housing market crashed, and the economy came tumbling down with it. B-roll banks had taken on too much risk, and they were left holding the bag, filled with worthless assets and a wave of defaults. B-roll credit rating agencies, the supposed watchdogs of the financial world, didn't fare much better. They had failed to adequately assess the risk of these mortgage-backed securities, giving them high ratings and lulling investors into a false sense of security. B-roll. The banks were left holding the bag, filled with worthless assets and a wave of defaults. B-roll. The crisis was not just an American problem, it sent shockwaves around the globe. As the fabric of the American financial system unraveled, the impact was felt worldwide. Major financial institutions, once considered invincible, crumbled like a house of cards. National governments were forced to step in, bailing out banks to prevent a total economic meltdown. Stock markets around the world took a deep dive. The Wall Street crash was mirrored from London to Tokyo, from Frankfurt to Mumbai. This domino effect led to significant job losses, with millions finding themselves unemployed overnight. The world's economy was plunged into a prolonged recession, the likes of which hadn't been seen in recent memory. The aftershocks of the crisis were felt in every corner of the globe, affecting every sector of the economy. It was a stark reminder of our interconnected world, where a ripple in one part can create a tidal wave in another. The world stood on the brink of the worst economic downturn since the Great Depression. The crisis left a lasting impact on the world, but it also taught us some valuable lessons. In the aftermath, regulations on banks and financial institutions tightened significantly. Governments across the globe took a more hands-on approach to financial oversight, ensuring that the recklessness that led to the crisis could not be repeated. This was a stark reminder of the importance of transparency in the financial sector, an element that had been sorely lacking in the lead-up to the crisis. Moreover, the crisis underscored the crucial role of risk management. Financial institutions were forced to recognize the potential pitfalls of their actions and to take steps to mitigate these risks before they spiraled out of control. This period of financial turmoil also shifted our understanding of economics and finance. We came to realize that the financial sector is not an isolated entity, but rather an integral part of the broader economy, with its health and stability impacting all other sectors. The global financial crisis was a wake-up call for the world, reminding us all of the importance of prudent financial management and the dangers of unchecked risk-taking.